Good evening. Good evening. As you're logging in and audios are turning on, good evening. Good to see you. I am just going over to Discord real fast. In case anyone needed the link, it's going to be there. Whoops. Paste. Bam. Bingo, bingo, bingo. Okay. Okay. My screen is not on. I'm like, you should be sharing my screen now. Now you should be seeing my screen. Starting now. Hello, Perry. Hi, Bob. Good to see you guys. Good to see everybody. Good evening. Thank you, Stephen. We've got the usual suspects here. Ready to discuss options. Hi, Graylin. Good to see you. Glad to have you as always. I hope. Here's what I hope. This is for everybody. I want you know, it's a hard thing. If I said to you, would you rather be overwhelmed or underwhelmed? Of course, I always would rather be overwhelmed, right? Like, and is there such a thing as just simply being in a state of whelmed? I'm whelmed. It's perfect. Whelmed right enough. Oh, Bob, small procedure. Good luck. I hope it goes well. Pop in, say hello, let us know how things are going. We'll miss you. Yeah, so I hope it feels like, we hit it pretty hard. The theory. Like, I want you to see diving into this thing. You can always go back, watch the video again, replicate it, etc. So, anyways, but I don't want you to feel like you're drowning. I don't want it. I want you to drink from the fire hose, but I don't want you to feel like you're drowning. I'm not trying to waterboard you. I'm not torturing you. Just giving you a nice, you're thirsty for knowledge. I want to help. But let me know if it feels like, well, too much. Because I know it's easy. Sometimes we just veer into the weeds with options sometimes. And it's like, okay. And we can always take a step back and say, how did we get here? So we know, like, what. Anyways, love these options discussions. I'm very excited. Welcome everybody to the Market Watch Group, Options Foundations 2.0. 2.0. Paddling above water. Love it. Doggy paddling works. Head above water. That's all we need. Selling options application day. So, if you missed it, on Thursday, we did selling options lecture day, I guess we would call it. I hate the thought of lecture, but it was the presentation. And now it is the application. Disclaimers, as always, here they are. You know them, you love them. If you read them, you can put yourself to sleep with them at night. Today's agenda: quick covered call review, quick naked put review, covered calls, naked puts. That's our entry level selling options. When you are, anytime you have a net credit, so if you have a bull put spread, a credit spread, a bear call spread is a credit spread. If you sell an iron condor, that's a credit. You're a net seller. Now, in each of those instances, you're also buying, you're doing a combination of buying and selling, but the net result is you're a seller. You can do bull call spreads and bear put spreads. Those are debit spreads. You're paying for those. And you can do condors, which is a similar construct as an iron condor, but you're a net buyer. And I want you to understand this even today as we start with selling. Credit is not necessarily better than debit. So a lot of people will be like, I love credit spreads because I put money in my account on day one. That was my snooty voice. Did it come off snooty? They're like, ha ha, posh, I like to sell. But you don't you put money in your account on day one, and then your broker yanks it away from you, and they put it into a margin account. It's like an escrow. That's not your money, right? You don't get to spend it. You don't get to trade it. It's held. It's held as the collateral for the trade. And in fact, most times, not in covered calls, in covered calls, when you sell a call, that is covered, hence the name, very clever. That is that call that you're selling is covered by the fact that you own the underlying stock. If that contract gets exercised, you don't need to go out and buy the stock. You already own it. They're just going to take it from you, right? Remember that as a seller, we've changed perspectives. We don't have rights. That's for buyers. We're sellers. What do we have? We have obligations. We don't exercise options. That's for buyers. We have risk of assignment. That's where we're in the pool and the OCC reaches in and randomly yanks us out if somebody on the buyer's side decides to exercise and say, I want to use this. They're like, okay, let me find somebody. Yoink. If it's you, it kind of sucks, right? You have to earn it, Bob said, right? That's exactly right. That money gets held. So with a covered call, no margin requirement. What is the requirement? The requirement is that you own the stock, right? You own the stock, so you're bullish on that. Now, here's what's interesting. Selling a call, remember that everything is reversed. We have obligations. We have assignments. If somebody thinks the market's going up, they're going to buy a call. So why would I sell it? Because I don't think it's going up. And if you want something to not go up, even better still is if it's going down. So in that regard, selling a call is actually bearish. So you might be thinking, wait a second, then why are you doing a covered call? Well, remember, you own the underlying stock. That has a delta of 1. If you sell a underlying call, it's smaller. That doesn't behave as big as the underlying. And so the net result is you're still bullish, but you've hedged by collecting some premium. So when would we do this? Either we're doing this because it creates potential for premium and income, or if we own a stock on the long term, we're doing this because we think the stock's at resistance and it's going to drop, and then it's going to hit support, and then it's going to turn around and come back up, and that might take a couple weeks. So if I can sell a call, I might be able to make some money while I'm just sitting here. Otherwise, I just sit on the stock. So when you're looking at something and you think it's overbought, it's overextended, it's probably going to consolidate, that's the time to well, let's just dive in because we're doing covered calls reviews. That's the time to leg in. You've already acquired the underlying stock. Now you're selling a call at a later time, a week later, a month later, a year later, doesn't matter. Stock has no time considerations with it, but options do. So then we look at the prospects of selling a call. Now that is if you own a bunch. So let's just say you have stock. Maybe you have 1,000 shares of company stock and you're like, what do I do with this? Oh, you could sell covered calls and generate, right? If you could get sell an out of the money option and get $1 a contract, that's $100 a contract. That's $1,000 a month. Selling an out of the money option. Now, what's the risk? Well, the risk is if it goes up and the call is in the money, you're going to get called out and they're going to take your stock. So if you really, really, really want that stock, this might not be the strategy. Or if you're really bullish, if you're like, this stock is going gangbusters, remember that when you sell a call, you are putting a cap. Whenever you sell an option, you have a very finite potential for gain. You can only make so much money, and that is determined by the premium. The premium is max gain. Well, no, that's not exactly true for a covered call. If it's an out of the money option, you get the premium and you get the potential between what the stock price is and the strike price. So if I buy a stock for 53 and I sell a $55 call, that's out of the money, I can potentially make $2, 53 to 55. But once it gets above 55, that's the cap. If that stock goes to 100, I get nothing above 55. Right? Nothing above 55. So if I get $2 a premium and I get that potential $2, I have the ability to make $4. So essentially when I buy a stock for 53 and I sell a call for $2, it reduces my cost basis from 53 to 51. So theoretically, I'm into the stock for 51. I sell a $55 call, that's a $4 gain. That's it. That's what I have the ability to make. And this is interesting because I worked for an education company one time that had a pretty cool covered call search. I've never, when the company fell apart at some point after I left, well, they had just really dissolved it. It actually became a part of Ameritrade, and then Ameritrade dissolved it. But they used to have a great search that looked for high premiums. I mean, one time everybody found this stock. It was such high premiums. What was a pharmaceutical, and they had a drug in clinical trials. And when the news was released, it gapped. I mean, it was like a $45 stock, and then the next day it was 110. Like, no kidding, 110. And of course, what's everybody thinking? Well, now they don't want to have sold the calls. They want to buy the calls. If you bought the $45 call, that call has $55 of intrinsic value. That's enormous. But what happened? Well, the stock was at 45 and everybody sold $50 calls. It's $5 out of the money. And they were getting huge premiums for it, like $7. And what we would tell people is there's a reason. There's a reason those premiums are so high. Now, in this case, it worked out fine. That stock could have gapped down from 45 to 30. And if it gapped down from 45 to 30, remember the situation. You buy the stock for $45. You get a $7 premium. Well, that covers you down to 38. But if it drops to 30, you're getting beat up. You're getting $8 loss per share. The call's not helping anymore. You're in a bad place. So that's one risk, is if it gaps through everything, you got to buy back the option, which is going to take a huge loss, and then you sell the stock. So actually, no, I'm sorry. Take that back. The option will expire worthless. But you're going to take a huge loss on the stock, right? You bought it at 45. Now it's at 30. Take a $15 loss. 7 helps, but not much. So these are the strategies, right? So I can buy the stock and sell the option at the same time. We're going to look at that today. What are the benefits? You get immediate income. It reduces your capital requirement a little bit. If you do this in a margin account, theoretically you don't have to put all the money up. You could be buying the stock on margin, but it's not that beneficial. But you have a lower capital requirement to just simply buying the stock. So doing it all at once versus you already own stock that you've owned or you want to own. Buy right's going to have less I want to keep owning the stock intentions. You're actually doing it with an intention of getting called out. When you get called out, you're at max gain. But back to the example, right? The stock's now at 110. And people are like, what can I do to benefit? They want that money. And I'm like, the option that you got $7 for, right? Remember, it was a $50 call that they got $7 premium. Huge. That's a huge premium for $50 for a month. Those options are now trading for $65. So they sold it for $7. And now what? And now if they want to uncover the stock, they have to buy that back. They could buy back their option. So what they sold for $700, they now have to pay $6,500 to get out of it. $6,500. That's the loss. So they take that loss in order to what? Hope the stock keeps going higher. What if you take that loss and then the stock all of a sudden drops from 110 to 70? Now you took a loss on the option and the stock is dropping. I mean, that's the risk there, right? So what did we counsel people to do? Absolutely nothing. Wait until either A, somebody early exercises. That happened to some people. All of a sudden, stock just starts disappearing, right? Because people are like, I'm going to buy. So when it disappears, it's not, what happens? They bought it for 45 and someone just bought it from them for 50. They made $5. They didn't make 55. They made 5. That's the risk. You don't get that upside. So if you're very bullish, this is not the strategy. If you're very bullish, covered calls, selling naked puts, it's a very limited strategy. This is a strategy that is somewhat bullish. It's somewhat bullish. Yeah, it's going up. It's pretty good. And hopefully it has good premiums. It has good premiums. Stephen can attest that right now, selling covered calls is a little frustrating. Why? Because you're not getting very much money. You're putting your stock up, or you're putting but you're not getting chunky premiums. You're getting paltry premiums. They're not very a low VIX. It's just not that beneficial for selling options. What are the considerations? Buy rights offer immediate income, but commit to the option up front. Legging in provides flexibility, but may miss out on immediate premium. Okay. What are we going to focus on? We're going to focus on the buy right strategy. We're not going to assume we have 100 shares of anything. It doesn't make sense right now. We're going to do a buy right, and we're going to look at a naked put. Now, a cash secured put and naked put are really not that dissimilar. It's just simply you have all the cash to cover. That's what you would need if you were doing it in an IRA. Versus if you only wanted to put up around, let's say 20 to 25% of the stock price. That's where you're putting up margin. You're making a deposit into that escrow account that we talked about. That's what your margin account is. A lot of people just assume it's a loan. If you buy stock on margin, that is using it as a loan. With options, margin has a different feature. Margin acts as the escrow. So when you sell premium, they put it in there and keep it there, and they take some of your money that's required to cover that trade, and they put it in there as well. And they tie it up. That money's no longer available to trade or withdraw. It's tied up in your margin account. It's not spendable. It's not lost or gained. It's just sitting there. When the trade closes, it opens that back up, and then you realize a gain or a loss. That's why I say it's a flawed perspective, right? It's a flawed perspective to think, oh, it's better if I collect money on day one. It's not. They're going to take that money, set it aside. They're going to take some of your money and set it aside. Versus if I buy a spread, they're going to take some of my money and they put it aside, meaning I put it into the trade. It's gone either way. That's not an advantage that we think, oh, they're just different. They're not better, different. Keep that in mind. So we're going to look at naked puts, which involves, instead of buying the stock and selling a call, we're going to sell a naked put, a little out of the money. You're going to see how similar those strategies actually are. A lot of people actually start covered calls by selling naked puts. And if they sell a naked put and nothing happens, they keep the premium and they do it again. And then they keep the premium and they do it again. And all they're doing is selling a naked put and let it expire worthless. But if they sell it and then all of a sudden the stock drops a little bit, then someone's like, oh, I'm going to put the stock to you. So in this case, you're selling put options without holding an offsetting position. That's what makes it naked. With a covered call, you own the stock. That's covered. Here you have nothing. You're just selling this put. But what you do have is a willingness to have the stock put to you. You buy the stock. So if the stock's at 52 and I sell a $50 put and I get a couple bucks for it, and the stock's at 52 a month from now and I sell it and I get a couple bucks for it, and then it's at 52 and I sell it, right? It's just kind of going sideways and I'm just collecting $2 and all of a sudden it drops to 48. Oh, well, now what? Well, now somebody has the right to force me to buy that $48 stock for $50. I've been selling that right to people, and all of a sudden now they're like, aha, now I get to, well, you've collected 6 in premium already, right? So that would take your purchase price of 50 down to what? 44, because you sold $2, sold $2, and now it's at 48. And you might be thinking, oh man, I had to buy it at 48. It was at 50. Well, if you've already done 3 months worth, you're actually at 44. You're at 44. The stock's at 48. Now what? Now I turn around and I sell a $50 call. Right? So I started with a naked put. They put it to me. Now I sell a $50 call. I get another $2. Now I'm down to 42. And now it sits. And let's say it sits at 48, 49. And then another month, I do it again. I sell the 50. It's at 48, 49. I sell the 50. I do another $2. Now my cost basis is down to $40. And then all of a sudden that month it goes to 51, 52. And what happens when it goes to 51 or 52? Well, someone has the right to buy it from me for 50 and it's at 52 or 51. They're going to do it. So now they buy it. Well, that stock that I have now ultimately paid $40 for, I'm now selling for 50. I just made 20%. Did it take 4 months? Yeah, that's okay. 4 months to make 20%. And that's on a big chunk. You're tying up. This isn't like buying options is smaller amount. This is larger pieces of your money. So this is where you're really using options and the value of time decay, the benefit of time decay, to significantly shift the probability in your favor. Odds of success are higher. What does it have to do? Not much. It just has to stay above 50. What if it doesn't? Well, then I buy the stock and then I sell the cover call. Then I keep going. Right? And as long as the stock doesn't absolutely crash, I'm going to be okay. I'm going to keep selling premium and right. And so you're just sort of, that's a whole different mindset with options that options opens. So, I mean, if you're in growth mode, you're not there yet. But when you get your portfolio to a certain point and you have the ability to, take larger chunks for strategies where you're still only risking 1%, but you're tying up a lot more money, right? If I buy an option, I might risk 1% and only tie up 2 or 3% of my capital. Doing something like this, I might risk 1% and be putting up like 15, 20% of my capital. So I might only do like 3 of these at a time, but that's taking large pieces of my account, putting it into what? Into strong stocks, strong leading stocks in strong sectors, and then capitalizing from time decay. That's Stephen. I'm gonna get to that. It's a little bit. I'm gonna read that as we get to the end. That's an interesting story. So let me know if you have any questions about this. Naked puts and covered calls are kissing cousins, man. They're from a lot of people are like, oh, I would never do a naked put. And you're like, what do you think about covered calls? They're like, yeah, no problem. They're the same thing. They have the same risks. I will show you that now, but let's go take a look. So let's go take a look at the platform and let's build a few of these traits, because what is this going to do? This is going to set us up for this is going to set, I need charts first. This is going to set us up for spreads, which is our next step. Ooh, nice bullish day today. You can see yesterday we advanced with volume. We got one of those days back, a positive. Today, opened down, rallied though, nice bullish engulfing. Stochastics turning. Volume was not there, but I got to tell you, there's signals here for us. That's why I wanted to start here. Let's get to our watch list. Let's find. So we're actually looking for a couple things. I'm gonna make this a little bigger down here. Why? Well, I'm gonna look for something that looks bullish, and right now Apple or the SPY looks relatively bullish, but the volatility is quite low. There's no premium. I'm gonna see if we can find premium. Nothing there yet. AMD is close. I mean, you can see we had a weird, what happened today with I bet all semiconductors. What happened today? Did anyone see the news for? No, it was mostly just AMD, wasn't it? Okay. The hell's the matter with you, AMD? We'll still maybe look at that, but let's keep going through this. That's not terrible. Covered call or a naked put on Amazon. AXP has some pretty good premium there. Looking bullish, looking like it's ready to turn. Those look pretty good. BLDR, the volatility is low, but it's at 38, so it's actually still okay. Yeah, there's kind of a lot of things in here. Our city already turned, I would say a couple days late there. Caterpillar keeps on going. Capital One is close. Vol's not great. I don't want to go too long. Costco looks like it's making that higher low, getting ready though. But look at the options; they're cheap. I'd rather buy them. CrowdStrike, not bad. It's expensive though. You know what? Let's just grab one. Let's go. Ooh, AXP, Amazon. What do we think? Let's go with Amazon. That's a staple. That's a big, strong stock. Let's say we decided to go Amazon. Vol's mid. It's not high. It's okay. I feel like I want to find something better still. What can I put on here? Okay, give me 1 second. Volatility sizzle vol index. Add item. Okay. All right, I'm going to sort these by vol index. That's NA, so that doesn't count. I'm like, wait, that doesn't. SMCI, look how high it is. If you want to know what I just did, I took our watch list. Okay. I went in here to the settings and I customized it. And I scrolled down to V for vol. Where's V for vol? And I went to vol index. What the hell, Scott? Where are you going? I went to the vol index and I added the item and it popped it over. Okay. Now, when I did that, that's right here at the top. That's my vol index. If I gave it, you can see vol index. Okay. Then what I did was I clicked on this. Usually I have it this way alphabetically, but I went here and I went to this, and now the highest are at the top. So this is where, if you were thinking about something premium related, that would be helpful. SMCI, it's a big stock. It's expensive. The VIX, doesn't really work that way. Nvidia. So Nvidia, that's not bad. Naked put, I would. It's expensive, but that's not bad. Here's a cheaper one we could look at. Palantir. Yeah, let's try that. You guys good with that? Let me know. It's quiet out there. Are you getting a real good drink, or are you drowning? Let me know. I want a temperature check here. Processing. I can live with that. I can live with that. No one says drowning. We're okay. I want to go to PLTR. PLTR. And I want to go to, we'll go to April. Remember, as sellers, we never need to go for, we want the volatility to drop off that cliff. I wouldn't go more than this, probably. But we're going to look at two things, okay? We're going to look at two things. First, we're going to look at a covered call. What am I doing with a covered call? I'm buying the stock. Boom. I hit the ask price. That buys 100 shares of stock, okay? 100 shares of stock. Then what? Then I'm going to sell a call. What call? I'm going to go out of the money. I could go one strike out of the money. That's 24. That would mean I make 30 cents. If the stock goes above 24, I'll get called out. I'll make 30 cents. Plus the premium, which is about $1.30. Add that together, $1.60. That's 30 days, $1.60. I can't make more than that $1.60. That's my maximum. That's $1.60, but my cost basis is 22. No, my cost basis is 22.40, which is the stock price minus the premium. That's our capital outlay. So we have the ability to make $1.60 off of an investment of 22.40. That is a 7% return 30 days. 7%. Now, if I did that once a month, then theoretically, I mean, this is not compounding, but this is just if I took, now if I start compounding, it's going to be even more. But that's theoretically 84%. Well, 31 days. How many times can I do that? almost 12 times. Yeah. So if you have a chunk of your portfolio that can make 7% a month, and then when you get called out, great. If you don't get called out, what? Sell another call. Sell the stock. Do it somewhere else. You got a lot of flexibility there. But let's sell. But the other opportunity is this. Do this for 3 contracts. Oh yeah, I could do it for 3. I could raise this 300 shares. Here's the other consideration though. If I'm a little bit more bullish, I'm going to sell the $25 strike price. Now I have the ability to make $1.30. Yeah? From 23.70 to 25. $1.30. Oh, I hope they don't shut you down, Sandy, but if so, the recording will be up pretty quickly. Now I make $1.30 plus what? Plus the premium of 90. So I get less up front. Instead of $1.30 up front, I get 90 up front, but I get more on the back end. I get 220. Yeah. So now I make 220 on 2280, 220 on 2280. Now I'm at almost 10%. So that's doing what? That's doing an extra strike out of the money to make it a little more bullish. Now let's go back and look at this. 25 is here. If I'm above 25, I get called out. I make max gain. I make my 220. I might look at this and say, wait a second. I don't mind owning Palantir. I'm going to do the 26. What would that do for me if I did that? Well, if I did the 26, you can see your premium erodes. I wouldn't go any further than this, and I'm starting to think, I don't know. Your premium erodes, but your potential increases. So you now have the ability to make $2.30 plus 60 premium to 90. Right? We went from 160 to 210 to 90. Was it 210? I believe it was 220. Yeah, 160, 220, 190. So if you go further out of the money, what do you happens? You get less premium up front. You get more potential on the back end. So we're going to go with 25, right? I'm going to make sure I have an equal number of contracts to each 100 shares. 300 shares, 3 contracts. Now I have a covered call. So I have the ability to make, I said about $2.20. That's $220. If you look down here, you can't see it because it's in green. I know I could change those colors. Let's make that black. Is that better? Yeah, that's better. 660. I can make $660. That's 220 times 3 contracts. Now, what about to the downside? Well, if it's under 22, if it's under 20, or if it's under 25, I'm going to keep the stock, right? I'm going to keep the stock. If it's under 2280, I'm going to start losing money. So as I look at this, I might think to myself, okay, I don't want to lose more than about, let's say, $330. So I might come in here and say, I'm going to put a stop loss right through here. And that's keeping my risk at about half of the potential to the upside. So right now we're at 2370. Now let's look at how this would look. I'm at 2370. 22, what did we say it was? 2218. I'm gonna set my slices. I'm gonna slice to chart. There we go. That's live. That's the stop. Oh yeah, I feel great about that stuff. So basically, if it drops too far, and I might even go a little further as it gets close to see if that 50, if it's a break of the 50, but basically what I'm looking at here is saying If it drops, I'm risking 330. If it goes above 20, oh, that's 26. I didn't want 26. Hold on. I wanted 25. Enter. And slices to charts. There we go. There. Now, what I want you to notice is this. These are about 1-to-1 apart. Yeah? This is actually a little closer than this. If it gets above this, I make 660. If it drops down here, and that's by the end of the month, right? So I have 30 days. If it ends up somewhere in between, I keep the premium, I do it again. Down here, 330. Right? That's 2-to-1. We lost Sandy. That's a 2-to-1 with this type of a setup. Yeah, I like that. I like that type of a deal. Now, that's the covered call. What else can I do? Well, I could look at this and say, well, if I don't think it's going to come down here, what if I sell a naked put at 22? Okay. Whoops. We're not done here. We're not done here. You're not going anywhere. Let's bring up, if I can tighten that up a little bit. Yeah, that's better. That makes it easier to see. Let's uncheck this and let's say we decided instead to sell. Actually, if I want that same, I'm going to go here to the 23. I'm going to go out of the money. I'm going to do 3 contracts. Let's see. Here I have a delta of 178. Theta is 6.68. 24. That's a little closer to what it would be, I would say. Now, if you look, this is the naked put. If it drops down to 22.18, this is actually a $24 naked put. If it drops down here to 22.18, I'm going to get out. I'm going to stop myself out. I'm done. And if I do, the most I lose is 288. If it goes up, I'm actually getting much less. I think in this case, I like the covered call better. Let's just see here. This would actually, no, I'm going to say this is a better equivalent. And I'm risking about 337 to make a max of 597. And here I'm looking at 330 for 660. So I would say in this case, now from a margin requirement, this is going to cost me 300 shares times $24. That's about $7,200. Right? I have to put up about 7,200, but I make 660. That's a pretty good return. Whereas here on the naked put, my margin requirement is going to be, I would say 500, about $1,000. Yeah, about $1,000, maybe a little more, 1,500. But it's significantly less margin. But if you're not worried about the margin, the covered call, I think, makes a better trade. Am I doing a buy to open naked put? You cannot do a buy to open naked put. You can only remember that a naked put is a short position. So the only way to have a naked put is to sell to open a naked put. So if you notice here, anything in pink is sell. This one here that has the green, which is the buy, is to buy 300 shares of stock that would combine with selling 3 contracts of the 25 call versus this. Now, if you buy to open, if I do a sell to open naked put and it goes above 24, it should expire worthless and you keep the premium. Correct. Anything above, in this situation here, well, this is the 20, that's the 24. If I do the 25 to make them a little bit more equivalent, right? The 24 is going to change the probabilities a little bit. Whoops, that's what I meant to do. That has a higher probability of success, but remember that now your max gain is 414. So your max loss still 288 to 414. Now you're only about 1.5 to 1, which isn't terrible, but you to get higher probability, you're sacrificing reward to risk. Am I doing a covered call? No. These are all listed, Stephen, but if you notice, only one is checked at a time. So right now, we're only looking at the naked put. When I take this off and put these two checks in, now we're looking at the covered call. The reason it's confusing is because they look essentially identical. I mean, look at it. The delta, 178, 6.6, 8.4, right? 178, 6.6, 8.4. Let me get this back to 25, which is the equivalent. 183, that's 5 away. 5, that's a little less. 8, that's almost the same. So from a Greek standpoint, which essentially is demonstrating how we expect these trades to behave, the covered call and the naked put are almost identical. They behave exactly the same way. That's what I'm saying. The only difference is margin. But a lot of people are like, oh, I'm so scared of naked puts because they hear the word naked. But a naked put and a covered call are the same thing other than what you're tying up. But in this case, I do think that the covered call is slightly superior in the numbers, as long as you don't care that you're tying up more capital. Right? So that would be the situation. Now you can see that I can actually come in here. Now that I know I like buying that and selling the April 25, right? I can actually come in when I come here and I can do spread and I could do covered stock. And I'm going to do the 25. And that is to, did I do that wrong? What am I doing? I did do that wrong. Sorry. There we go. And I'm buying, let's adjust this down to 3. Buying 300 shares all at once for this. Remember we said we had 220. So I'm going to go ahead and confirm and send. If that goes on, great. We'll watch this thing, see how it looks. Naked put, you don't have to. So a naked put, you have to put up margin requirement. You'll have a buying power effect. You definitely will have a margin requirement. So if I go in, let me show you what that would look like. So if I look at the $25 put here, it is definitely your money. It is 100% your money, right? You are putting your money into a margin holding. So if I go here and I say I want to sell the 25, okay, that's my BP effect right here. So this is, let me get it down to 3 contracts. And this is a margin of requirement. They're going to take $2,000 of my money and they're going to hold it. They're going to hold it. I was wrong. What did I say? 20 to 25%. For 3 contracts, yeah, it's definitely a lot more. If I have cash of 0 approved for naked trades, they will loan me from my margin. That's a tough one. I would ask them. I'm not sure. I think that the margin may only be available for stock transactions, but not necessarily to cover new margin trades. I would ask them about that. That's a maybe. I haven't done, oh my God, it's been so long since I did margin questions. I can't remember. Plus, I'm not licensed, so I shouldn't talk about it. But yes, you have to have that money is coming from you. And if the trade starts to go against you, the margin requirement increases, right? So you can see that if the stock goes from 23.70 down, they're making you put more money up. Where do they get my money from if I have zero cash? They won't let you do the trade. You're approved for naked trades, but just like if you're approved to buy options and you don't have any cash, you can't buy options. So if you are approved to sell naked options, but you don't have funds available to trade them with, well, then they're not gonna let the trade go through. They'll reject the trade, right? The system is well primed for that. That's not a, if you tried to place it, they would just reject it and would give you an explanation. Then you could call and find out why. So yes, naked put or a cash secured put would just be simply that you need $7,500 sitting here to cover this thing. So if I did this, let me see here. Let me go to the IRA. Yes. Now look, okay. I switched us to the IRA. Now, if you look at the $25 put, the margin requirement is the full amount, $7,500. That is cash secured. So we have three potential trades here on Palantir. Sell the cash secured put. I can make $660. If I'm wrong, I'm trying to only lose 300, 330, and I have to tie up $7,500 of my cash. That is if it is not approved for anything but cash secured, level one, like a retirement or an option account that hasn't been approved yet. The other level one strategy, if I switch this back to margin, is the covered call that we placed the trade for. Let me analyze this one more time and uncheck this. So that's this trade. That is going to be a $3,500 buying power effect. What does that mean? It means that theoretically, I'm buying the stock with margin, so I'm only putting up half the money. Instead of putting up 750 or 7,500, I'm only putting up about 3,750 less the credit. I'm only putting up about 3,550. So it's a lot more, right? It's a lot more than 7,500. And then you can see that the least requirement, I'm only putting up 2,000. So it goes from 7,500 for cash secured to 3,500 for covered call on margin. If you do the covered call without margin, it's 7,500. It's the same. It's going to be just like the cash secured. So those are your, right? So if you do covered call on margin, it reduces it to 35. If you do a naked put, it reduces it to 2,000. All basically the same variation of the same concept. I'm bullish. I'm somewhat bullish on PLTR. I think it has a good chance of getting above 25. But if not, I have a chance to take some pretty good premiums and improve the probability of success for this trade. That's my mindset. If your mindset is Palantir looks amazing, and I think it's going to make a smashing move up to 28, yeah, buy a call. Buy the $25 call for 90 cents. It goes to 28. They're going to be worth $3.5, $4. You're going to, right, make 400%, 300%. That's going to be a better trade. But how sure are you, right? Versus what does this have to do? Not much. If it stays where it is, you make 4%, right? 90 cents, you make 4%. If it doesn't move at all. If it goes a little bit up, you can make, you could make 7% and still come out owning the stock and do it again. Great. So these are the building blocks of selling, and how you look at the margin requirement. Now, what we're going to do next time is we're going to look at selling that $25 put, but instead of putting up all that margin, what if we were to buy one below it, right? What if, now you can see what it is. What if I come here and I buy 3 of these? Now you'll notice what's happened to my margin requirement. Oh, it's dropped substantially. 600? That's because I've moved into a spread. I've also offset a good amount of my credit. So my reward and my risk is not as good. So I would probably end up doing 6 of these, I would say. Maybe even more. 7, something like that. And now what? Now I have that same kind of risk structure. I still have positive delta. My theta and my delta vega are a little bit neutral right now. But essentially now, if this thing goes up, I can make $750 if it gets above 25. And I'm only losing $255 if it drops down here to 22.18. And that's a whole different trade, right? A whole different trade. So that's what we're leading to, is ways to effectively use our capital. And you can see my buying power is actually up to about 1,400. That's still less. That's less than the naked put, and it gives me a better reward to risk ratio. So I hope what you're noticing is learning these strategies, these layers of strategies, increasingly allows us to better use our capital and potentially find the best reward to risk ratio for any given situation. Because I promise you this, and Bob probably found this out as a buyer of these calls, they're expensive. It's harder to get a positive reward to risk ratio with expensive options. That's just how it goes, right? So, whoo, what do you think? This worked out good, I think. So we were able to really compare and contrast cash secured put, which is good for retirement accounts, which is good for accounts not approved for margin or for level 4 options, which is naked options. Okay. Then we moved on to covered calls, and covered calls, same thing. It's level 1. If you have a margin account, that will reduce the margin requirement by half. Right? And that's a covered call on margin. Then we have naked puts. Naked puts is going to reduce your margin further. That's the progress. Bob said too fast. It's a lot. I know it's a lot. It's a lot. I get it. But what I want you to understand is you may not even do this trade. You might be learning this step simply to where can you find the earlier classes? Those classes are here in the Market Watch group, YouTube. You will find a wealth. They're also going to be in the so if you look back here, you can see that was the presentation for this. And then you can see here, this was basic options. Where's the original one? Key concepts. Dun, dun. Huh. I might. Well, there's the basic. That's the important one. Basic options application, basic strategy application. That is your buying calls and puts. Buying calls and puts, 312. And there's a lot of good stuff through here. Intro to options, building a trade. I mean, there's just a lot of good stuff. Jump in here, have some fun. I don't know. Yeah, just that's what we're looking for. Okay, did very well with 2 butterflies this morning. Money on both as the SPX went up then down. Okay, very nice. Same day butterflies. Yes, Graylin, you're welcome. Anytime that there's something that will help, just ask. I want you to feel comfortable to explore it. So, what's next? Tomorrow morning. Yeah. Tomorrow morning we will do our midweek check-in. I think things are looking bullish. We are bullish. Bulle. Okay. It's good to see you guys. Yes. Would you? Steven had that's a great idea. Steven had a very interesting one. It was just kind of long and it would take a while to kind of talk through it and set it up. But he's going to post that as a story in Discord. Oh, sorry. No, I'm going to put that in Discord. I want to make that a discussion. Are you good with that? I'm just going to go post that. Okay. Awesome. Okay. It's good to see everybody. Have a great rest of your night. See you in the morning. As always, happy trading.